Good afternoon, everyone. Today we have with us a panel of experts to share and discuss their view on the various investing instruments, primarily stock, CFD, and alternative investment. Understanding which instrument suits you, your needs, and your risk appetite better. So a short introduction of them. Today we have with us our host, Claressa Monterio, and we have with us our guests, Kerry Wong, Ee Chung Kek, and Oommen Mathews. So let us, put our hands together, and I'll hand over the time to Claressa. Thank you.
Thank you very much. Good evening, good afternoon.
Morning.
Hello. Hello. Can you all hear me? Okay. Our first speaker, Kerry Wong, Research Manager, OCBC Investment Research, has over 15 years of experience in the financial industry, spanning both the fixed income and equities market. Today, he's going to be talking about equities. He's going to tell us about them. Would you like to demystify equities for all of us?
I will try my very best. Hi, good morning, everyone. Thanks for coming. Once again, my name is Kerry. I'm from OCBC Investment Research. What I'm going to talk about is basically equities. I'm sure most of us have a very basic idea of what equities is. Equities is basically just a share in a company. What exactly are shares? Shares are basically ownership, something that you own in a company. A lot of us, we sometimes take partnerships. For example, when there's a big toto, $5 million, a few of us will pool money. Once we put our money in, we have a share, a stake in the pool, and that makes us shareholders. So same thing in equities market. This is a public listed company. Our ownership is limited by shares. Now, when we put shares in the company, we are basically providing the company with money for it to grow its business, for it to run its business. And at the end of the day, what we want to get back from it is basically returns. The company makes money, we get paid. Hopefully either through share price appreciation or dividends.
So what are the advantages, mainly, what are the advantages of investing in equities?
Well, I guess one of the main advantage of investing in equities is what we call transparency. It's listed on an exchange. Everyone has access to the price. For example, in the past, we have teletext. I'm sure a lot of us are quite familiar with teletext. You just on the channel and you see, the list of prices, the top 20 traded shares. There's a buying and there's a selling price. And you do the transaction, they are all above board, i.e. you don't deal with a shady person, like you don't even need to know who's your counterparty. All you have to do is you tell your broker, look, I want to buy 5 lots of, say, DBS shares. They'll put in your order and then they'll match your order, and at the end of the day, if your price is met, you have done your trade. You have bought 5 lots of DBS without having to know who's your counterparty. At the end of the day, your money, you just pay to your broker goes through CDP and you get your shares in CDP. Simple as that.
So it's safe?
Yes, it's very
safe. It's safe to trade with equities?
Okay, there are different sorts of risks. So, of course, as with any investment, there are risks. So when we talk about trading in equities, what we get is you get a very organized system. It's not where you go to the market, you can haggle and stuff like that. Sometimes you can, if you're buying a very, very large block of shares, but most of the time, when you put in a trade, you accept the price that's being traded. Or what you can do is you can put your bids and offer away from what is currently being traded in hopes of you move in the direction of what you want. For example, if the share is trading at $1, you think that maybe I don't want to sell at $1, I want to sell at 105. So you tell your broker, okay, I'll put my price at 105. So if the price does rise to 105, you probably get done. Okay, this is what we call transactional risk. It's very low. Of course, we have a different sort of risk. That is completely different. For example, we have what we call investment risk, liquidity risk. You buy into a share, for example, that is not well traded. So what we call is when a share is not well traded, there's this price discovery risk. a lot of us don't know what the actual price is. For example, we cover companies. We provide research on certain companies. If a company is not well researched, nobody other than the insiders will know what's the value of the company or what the share price should be trading at. So that is potentially a risk. Then of course there are also market risks. For example, you buy into something, the next day you have a war somewhere and everybody panics. They want to hold cash, they want to hold gold, they want to hold US dollars. So what do? They just sell. So when they sell, prices come down. It's a matter of demand and supply. So when there's more supply than demand, what happens? Share price will just naturally drop.
Would you say that equities is a long-term investment?
I guess it's depending on the time horizon. How do you define investment? We have different stages where sometimes when you invest, right? Typically from a research house, we have a horizon of no less than 6 months to 1 year. So when we set a price target, for example, we are saying that over the next 6 months to 1 year, the shares should return you this X amount, including the dividend. Of course, there are what we call speculation. These are what we sometimes, look at the market and think that, for example, there's an incident somewhere that causes oil prices to go up. So what we want to do, we want to buy into companies that can benefit immediately from this oil shortage. Yeah, so this is something that is very, very short term. Your returns, you can get it within a certain number of days, sometimes even within the day. You see, so it's a different thing when you want to say what is investing and what is speculation. There's no hard and fast rule because sometimes if I need money, I'm going to say I'm going to buy something within the next 3 months, but I still have a sum of money that I can use. Then my time horizon for investing is only 3 months. Yeah, but if I have a retirement fund, something that I'm planning to hold till I'm 65, for example, then I have a lot more time, so I can slowly accumulate. I'll buy shares that provide me with steady returns, very good dividend, so I enjoy the compounding impact.
Is there anyone on the floor at this point that has a question for Kerry? Yes. Bearing in mind that he cannot give you specific shares, he might be able to talk about industries or counters. Yes?
Well, I guess I probably won't go into share specific, but I think at the moment we are still pretty positive on equities. Yes, there's a certain risk that if you look at the Dow, you look at S&P, they're hitting new highs every day. So the market is looking for a pullback. So again, as in investing, when you buy a house, you buy a car, timing is also everything. You want to know when to buy, but you must also know what you want to buy. So at the end of the day, what we say is, yes, we still like equities, but probably now may not be the time because if you look at valuations, now why do we look at valuations? Valuation gives us a sense of how pricey or how cheap a certain investment is. For example, shares, you probably heard of what we call PEs. PEs are basically price divided by earnings. So we take a price of a share, divide by earnings per share. And what it does, it gives us a multiple. And then we use this multiple to either compare against itself, say over the last 5 years, or we compare with another company that is trading in the same industry. It's just like housing. If your neighbor's house is going for $1 million, your house should theoretically go for $1 million, right? Because you're his neighbor. Your house is the same format, same age. So we use the same theory, we apply to shares. For example, we have two banks. They are almost of the equal size. They should be trading pretty close in terms of multiple to each other. But share price may not be the same because of the very fact that each company may issue different number of shares. So that also impacts the earnings per share because, for example, I make $10 million, I have only one share. My EPS is $10 million. But if I make $10 million, I got 10 million shares. My EPS is $1. So if I apply the same valuation, say 10 times. So the first company, 10 times 10 million is $100 million per share. But if you 10 times $1 is $10. But in terms of PE-wise, they are the same. You see, so this is a concept that helps us cut through various companies to, it's a quick and dirty way to compare this company. If this company is trading at 25 times, another company is trading at 10 times, but they're essentially doing the same business, which one should I buy? Odds are I'll buy the the 10 times PE company. You see? So it's a matter of where you want to look at. And for example, at the moment, we still like shares, but we are not very, very hot on, say, commodities. Because if you look around the world, yes, US is doing okay. China is still not doing very well. But we must not forget, China is the one that is consuming most of the... I think that's a pretty touchy question. Yes, I'm sure the history of the Chinese companies, will probably leave a very bad taste in a lot of people's mouth. Well, we don't want to talk too much about it, but if you look through the list of stocks that we cover, I can safely say there's probably no Chinese companies inside. Ouch, yes. Okay, Tukang is a Chinese company. It has a dual listing, yes.
Oh, sorry. Yeah, can you elaborate? Because Dukan, I got it for quite some time, but it's only 20 cents. I don't understand why, other than a China company, the sentiment is so bad, but the valuation is very low, right?
Well, I guess again, okay, let me go a little bit into valuation. For example, there are certain ways to value an object, for example. If you look at this bottle of water, right, we have what we call intrinsic value. How much does it cost to make this bottle of water? So the plastic probably costs 10 cents. The water itself, if it's from the tap, is another 5 cents. So intrinsic value is 15 cents. But if you give it to a guy who's dying of thirst, I'm sure you can jack it up, right?
$10.
Yeah, I mean $10 you probably, unless it's, the guy going, I want Perrier, no Perrier, So again, it's the prospects. So for example, your company is making something that is not really in demand, or you see the market for it is not that good. For example, Tukang makes Chinese wine. The thing is, in China, is everybody is turning westernized. A lot of people don't want to drink Chinese wine. They call baijiu, they think it's hard liquor, it's not fashionable. People want to drink vodka, they want to drink gin or scotch. You see, so it's facing a changing market where, for example, if you drink Chinese tea, nowadays you go China, everywhere there's a coffee shop. People are turning, westernized, they want to drink coffee. So if you're selling tea, right, you're selling to a smaller and smaller market. Same thing with Tukang, if you're selling Chinese wine, the market itself is shrinking because the demand is not going to be there.
So it's not cool drinking wine, Chinese wine. Okay, rice wine.
Thank you for your questions. Anybody else has a question now? Let's give someone else a turn. Anyone else? A question for Carrie on equities? Okay, I have a question. If I have $100,000 to invest, how much of that should I put in equities?
Well, I guess, again, we've been saying it depends on which life stage you are. For example, you just started working, you're probably saving up for a house, you're saving up for marriage, then probably not a lot. You probably want to start small, maybe 10-20%, which you think, sometimes I've been corrected a few times. When we say, how much should you invest? And then sometimes we always come out with this, invest only what you can afford to lose. Then somebody gave me this very good wake-up call. But nobody can afford to lose anything, right? Who wants to go into investment wanting to lose money? But I think that is the fact of the matter is that, once you take up something with risk, the risk is always going to be there. You have to know that you have got to take a little bit of risk that you could lose some of your money. Because it's like a gamble. You go to a casino, right? The risk is 100%. Either you win back your money 2 times, or you lose it. But equities is basically you're buying into a growth of a company. You're buying into what you think the company would be worth in a year's time, 5 years' time. So we want to look at, when we say blue chips are companies that have a very long trading history. Say, for example, Keppel Corp. They've been around for donkeys of years. The order book is $15 billion that stretches out 3 to 5 years. So it has very, very good fundamentals. You know that the orders for oil rigs, the orders for submersibles, they're still coming in. People are still doing oil exploration. So you know that they won't run out of business within the next 3 to 5 years. So this is what we like about blue chips, for example. So if you are out investing, for example, you want to look at companies with, pretty safe. Because at this stage of your life, you don't want too much risk. Because you can't afford to wipe out your capital because you're going to buy a house, right? So you probably invest 10-15%. You want to get something what we call dividend-paying stock, for example. That would probably help build up your investment sum. You collect the dividend, you reinvest the dividend. And this will help you grow, and you'll be surprised how much you can earn from this. For example, if you get into some of the REITs. The REITs are what we call business trusts. They manage, for example, a shopping center. They collect the rent. They take their management fee and they pass it back to shareholders. So for example, for a REIT, they can pay between 6-7%. So if you compare 6 to 7% against FD, 1%, you're up already 5%. So you're growing your investment sum every year. And then as you mature, right, once you've got your house, you got more money, you can set aside a bigger sum. And then that's where you start shifting between what we call very safe dividend stocks and what we call slightly more speculative stocks. Stocks, for example, like your grandmother's friends, auntie, gave you a stock tip. Sometimes they may know something. You just say, okay, I'll just buy a little bit. Hopefully it doubles or, it goes up 10-15% in 2 days. That could be possible. So again, it depends on which stage of life you are. And then as you go into your retirement age, for example, you're 40, you think that, I've been now 25 years to save. Then you want to buy very safe stocks again. Your dividend-paying stocks that you think that will still be around, you can pass to your children, your grandchildren. You don't even have to touch your capital. For example, if I buy into a stock that pays me 5%, my capital is protected. If I have $1 million, I put into 5%, I get $50,000 a year. I don't even have to touch my capital. I can survive on $50,000. And this should be the thinking behind why we look at equities.
Okay. Before we move on to the next speaker, are there any other questions for Carrie?
Sorry, Carrie. Just another last question. I mean, you say about the getting 5% dividends. Are we in the game of not, there's other kind of like, you're trying to, shouldn't we buy companies that is, 10 cents on the dollar, that kind of thing, so that we can make 1,000% rather than take the dividends? Can you elaborate on that?
I guess it's, again, the amount of risk that you want to take. For example, if you buy a penny stock, let's say the stock is 10 cents. Every 1 cent move is 10%. It's a very big swing, right? How many of us can take this type of swing in a day? Right, so if you are really speculating, maybe you want to take a short-term punt, for example. You think that this stock is 10 cents is too cheap. You want to maybe put a small amount of money there. I mean, the Chinese will say tikam tikam, You want to take a gamble. Hopefully that one makes you money. But for most of your funds, it shouldn't be very small penny stocks because they are pennies for a reason. When a company builds up its reputation, builds up its business, it shouldn't be worth, 10 cents. So if you see a 10-cent stock, chances are something is not quite right. You know what I mean? You don't have Keppel trading at 10 cents. You don't have DBS trading at 10 cents. You see? So that is the difference. And I think if you look at the latest SGX announcements and the news, the stocks are going to be worth minimum 20 cents. You know, they cannot be lower than 20 cents. Because that's also to protect you, because, you know, once you have a 1 cent movement on a 10 cent stock or 1 cent stock, it's 100%. How many of us can stomach 100% moves? We can't, you see. Unless, because at the end of the day, I can tell you from experience that it's not a level playing field. The retail investors are always behind the curve. When we buy into something, right, you'll be up against fund managers, you'll be up against traders, you even be up against remisers, dealers. These guys have instant access to the dealing system. And then you also hear of what we call black pools. They use algorithm trading, computer trading that is so fast that anytime you put in a price, you're already way behind them. So if you want to play very speculative stocks, you'll always be at the losing end. You know what I mean? And then your brokerage will also kill you because these guys have size. For example, if I put in a trade, I need to make $30 on one side. Two sides is about $50, $60 before I even make money. But for your house traders, if they do the trade within a day, they only pay clearing fee. You know what I mean? So these guys are already ahead of you. So if you want to buy very speculative stocks, that's your danger. It's very hard for you to make money against these guys. So that's why we always recommend to go into slightly safer stocks. You buy for a longer term. You know, contra is actually not a very good thing. Although if you think you have a tip, yeah, contra works.
Thank you very much, Mr. Kerry Wong. We move on. You can clap, you know.
Thank you.
We move on to our next speaker, Mr. Yi Chun Kit. He looks a little bit different from his picture, maybe a few years older. Senior CFD dealer at Philips. Now, what does that mean?
Okay. CFD, or contracts difference for short. Basically, it's a financial derivative product. It's a leverage product. This is slightly different from trading your traditional shares where you just buy and hold. For CFDs, it's much more speculative and much more short-term, I would say. The risks are definitely there because it's a leverage product, which means, for the example which Kerry quoted earlier, if you want to buy into 10 lots of DBS, for example, you will need approximately $13,000. Apologies, I'm not sure what's the price of DBS right now, but it will cost the entire capital. But for trading CFDs, the main difference is that all you need is just a fraction, 10%, for example, to buy DBS. So all you need is just $1,200, $1,300. So that said, the advantages of CFDs is that it is a leverage product, which means that for investors, you can actually maximize the dollar power. So for every $1 you have, you can actually buy up to 10 times or 20 times, depending on the products which you are trading. The other advantage of trading CFDs is that investors can actually go short. This is very much different from the traditional stock market where clients, investors, you buy into a stock and you hold for X number of years. Basically, for the traditional stock market, it's just one way, buy and hold. But for CFDs, you can actually go short, which means that if an investor actually holds a negative or bearish view on a particular stock index, he can actually go short on the stock and buy back the stock at a lower price, assuming the price goes down. So that is actually the advantage of trading CFDs. The third major advantage of trading CFD is that we have a huge range of products. So for Philips CFD, we actually are offering equities as well as major indices for trading for clients. So I would say these are the three big advantages of trading CFDs.
Okay, that's the advantages. How does that relate to risk?
Well, that's it. Risk management is actually very important, especially when it comes to trading CFDs, because as I mentioned earlier, CFD trading is not just for the basic investor, it's more for intermediate to advanced investors. So because it's a leveraged product, this means that, for example, if you are investing $5,000 or $10,000 and buying into a particular stock, and if you do not practice good risk management, you can actually lose the entire $5,000 or $10,000 which you put into a stock. This is different from the stock market. Because you're losing $5,000 to $10,000, this means that the entire stock which you're buying falls to zero. So you lose the entire portfolio. But for CFDs, if the price actually moves slightly against you, then you may actually run into a risk of getting a margin call or a fund call. So that is the main risk. So the advice which I have out here for investors is to practice good risk management. Regardless of whether you're buying into stocks, whether you're going into CFDs or going into any other trades, it is important to actually put a stop loss level. That is the one thing which I always advise my clients to do. Always practice good risk management, always put a stop loss level. So even if your positions get cut off, do not think about it, do not think about the losses that you have made. Just move on and plan and research for the next better trade so that you can make back whatever you have lost previously. So that is the one important risk management technique which I always advise to my clients.
So what influences the movements of your CFDs? Is it global? Is it, what am I looking at? I've never invested in the CFDs before. You've just come and spoken to me and I'm thinking, okay, I'll give you $20,000. What am I looking at? What are my risks? What do I need to know? Do I look at the political situation in a specific market, or what am I looking for? Because I know nothing about it.
Yeah, okay, the great thing about CFDs is that we give access to global markets. We have the Hong Kong markets, the US markets, Singapore markets, Malaysian markets, as well as major indices all over the world. So with that, it actually offers a very good opportunity to diversify your risk. I think the global markets this year has been on a very good positive roll. Most of the global stock houses, or rather the global major indices, the exchanges, have actually hit multi-year highs. Carrie mentioned earlier that the S&P 500, the Dow Jones have been hitting record highs as well. So with that, clients can actually go into index trading. The regional markets in India, in Indonesia, in Thailand has been seeing a resurgent note, especially in the last half a year due to the elections win in India, and as well as Jokowi's victory in Indonesia. So for us, we actually do offer trading in these markets indices as well. So actually clients that actually wants to come on board, it is still early, but do bear in mind the risk of the correction that, in my opinion, may be coming soon. Because if you've been keeping note of the market, the Dow Jones and the S&P 500 actually corrected. Rather, I wouldn't say corrected, but it has actually wiped out last week. A single trading day has actually wiped off 300 points off the Dow Jones index. So that has actually wiped off the entire gains for 2014. So that said, I think investors definitely need to take note of what is happening to the market. So if you're holding on to existing stock positions, one recommendation is that you can actually hedge your positions with the indices trading. Or if you're looking to long, for example, because at the end of the year, if you guys actually do know, the Hong Kong and the China Stock Exchange, they are going to undergo a mutual market access. So with that, we have actually seen institutional funds that's actually flowing and going into Hong Kong, going into China. So clients that want to actually jump into this bandwagon can actually trade into the Hong Kong indices or the China A50 shares that we're actually offering.
Okay. Forgive me if I'm wrong, but it sounds riskier than equities. Is it riskier than investing in equities?
That's for sure, because for equities, as I mentioned earlier, you can actually hold. But for CFDs, all you need is just a percentage or a margin of the entire contract value. So assuming that you're actually going long on a particular stock, or say the S&P 500, but there's an adverse movement against your position. So what happens is that you can actually find yourself in negative cash balance. So a margin call or a fund call may actually be triggered against your portfolio. So with that, you may actually have to cut off your positions or have to sell off all your positions, and that might actually lead to more losses than you may actually expected. Yeah. So trading CFDs is actually like a double-edged sword. It can work to your advantage, but it can also work to your disadvantage. So to make sure that this trading CFDs work to your entire advantage, you have to practice stringent and good risk management to make sure that whatever you have put in, you don't end up losing more than whatever you have put in.
Okay, risk higher, are gains higher?
That's for sure. I can't find a product that gives you higher risk and low returns because I think all of us here knows high risk means higher gains. So trading CFDs, as I mentioned, it gives you 10 times, 20 times leverage. So that means that if your positions are working against you or moving in your favor, your profits may be 10 times or 20 times whatever that you have invested. So that is the good side of trading CFDs. But that's it. On the bad side, on the flip side, you may also lose 10 times or 20 times. Yeah. So clients have to be aware and in mind of this.
Okay, does anyone have a question about CFDs? Maybe it's your kind of investment? Anyone have any questions? Okay, so we were talking about different life stages. Kerry was talking about, when you start out, you don't want to invest a lot because you want to buy a house. This sounds like the kind of investment that you make after you bought your house, after you've hit a certain point in your career, before you start thinking about retirement, when you are willing to take greater risks. Is that pretty much where we're at?
Yeah, actually, a majority of our clients are the executives, the professionals. We don't advise clients who are of nearing retirement age to actually trade into CFDs because it's a risky product. Because for clients that are younger, for people who are working, people who are professionals, they actually have a higher risk appetite. So trading CFDs would actually be much better for them, for the trading portfolio, especially if they are looking for higher gains. Yeah, because these are the age group that can actually bear higher risks.
So I can afford to lose it because I'm going to earn it back.
Well, just make sure that...
From my job, from other slightly safer investments. Okay. Is there anything else that you want to expound on as far as CFDs? I think there is a little bit of confusion, perhaps, still, what they really actually are. At least I am a little bit confused about what they are.
Okay. Actually, to go more in-depth on CFD, it is a derivative product that mirrors the underlying price movement of an asset class, for example, equities or indices. So clients can actually go long or to go short trading CFDs. And if clients are going short, you do not need to own the underlying shares. This is traditionally different from the stock market, where if a client is going short on the market, you actually need to own the underlying shares you're going short. Or if you're trading on options or extended settlement contracts, you actually need to hold on to the underlying contract itself you're going short. But for CFDs, you can actually hold on to short positions. And the best part is that there's actually no expiry date as compared to future products or options. Yeah.
So generally, how long do you hold a position?
I would advise clients to actually hold on. It's a very short-term investment, say probably between 2 weeks to 3 months at most. Yeah, because market conditions changes very frequently. So you need to actually monitor and look at your portfolio on a consistent basis, and not say just for stocks where you buy and then you leave it there for a long-term period. But for contracts for difference, you actually need to review your portfolio on a consistent basis. So on average, clients hold the positions from 2 weeks to 3 months. That is the average time span that we are looking at.
And going back to what I said earlier, I've got $20,000. I'll give you $20,000. What does that buy me in terms of a position? Do I have one position? Do I have two? Do I have three?
Okay, $20,000 can buy a lot of things. So assuming that you have actually 5 times leverage, which means $20,000 can actually buy you up to $100,000 worth of stocks, worth of indices. That said, you can also diversify your portfolio into the various global markets, into Hong Kong, into Malaysia, into US. You can go short. It really depends on your own risk appetite, on how much risk that you want to take. But that said, of course, the $20,000, you're not expected to use the entire $20,000 because if you are using up the entire $20,000, this means that there is no free balance in the account because you need to leave some sort of a buffer in case that the price moves against you or not in your favor. So probably with $20,000, the advisable amount to leverage is probably half $10,000 to $15,000, and investors must always remember to leave a buffer amount and not leverage the entire amount which you have invested into the CFD product.
Does that give you a yes?
Hi. So actually I have a question on your opinion. All right. So, okay. So we generally accept that the indices, trading on indices and maybe blue chip stocks are a safer form of investment in general as compared to penny stocks. Whereas CFD, the usage of CFD allows you for leveraging, which of course increases the risk. So in this sense, is it fair for me to say that to satisfy your risk appetite, you can actually use CFD to trade and invest in such in the investment vehicles which I just mentioned. So using CFD to trade indices, blue chip companies. Of course, there can always be market crashes, there can always be corrections and stuff like that. But generally, isn't it safer to use CFD and leverage on these blue chip companies and indices to allow for larger gains? Because like just as long as you have enough money, enough cash in your CFD account to account for the day 1, day 2 margin calls, then is there any downside to this opinion that you can actually use CFD to trade, use CFD, a risky asset vehicle, to trade in safer investment vehicles, so as to say?
Yeah, actually there are some clients that make use of CFDs to trade into stocks that gives you good dividend yield. So for example, Kerry mentioned earlier, REITs gives you 6-7% per annum. So there are actually clients that make use of CFDs to go into stocks that gives you high yield. For example, your blue chips, your Singtel, your Starhub, they give you around 4.5% per annum interest or yield. So a lot of clients actually use this strategy and go into CFDs. But for CFDs, one thing that clients got to take note is that because it's a leveraged product, there's actually financing charges. So it's between 3 to 5% per annum. So after taking into account the financing charges, basically clients can sort of arbitrage. So for example, if a stock pays you 7% interest or yield per year, less off your financing charges of 3 to 5%, clients can actually make 2%. That is on top of the capital accumulation if you're investing into a particular stock. Yeah, so there's various strategies of going into CFDs. It depends on how you use them. So I wouldn't suggest using CFDs on penny stocks because one day movement may actually see 1 or 200% decrease in the price. So if you're actually going long on that particular stock, then yeah, you may actually lose the entire 1 to 200%. Multiplied by leverage, you probably lose the entire portfolio in your account. Yeah.
Does anyone have any? Yes.
Hi. I've always thought of CFDs as one of the key advantages is to use it as a hedge against positions in an underlying asset. So could you elaborate on this process?
Okay. For hedging, it depends. If you're holding on to a stock position, for example, STI, blue chip counter, so you're assuming that, okay, right now you actually bought a particular stock at this particular price, and to hedge against a position, say right now, the geopolitical situations in Gaza, the situation in Ukraine and Russia, as well as the potential Ebola outbreak in Africa, if they're not contained, they may actually lead to global negative repercussions to the economy. So how to actually hedge is that you can actually go short on a particular index. So, for example, if you're buying, or rather if you're owning a Singapore Stock Exchange stock, STI stock, index component stock, you can actually go short on our STI index. So assuming there's actually a correction, at least the losses which you make to your stock portfolio is actually much lesser. So the net loss from your stock position is actually matched up with the net profits which you have made from shorting the indices. So at least your losses are actually minimized. But that said, it also works the other way around. So assuming that the entire market actually ignores about the geopolitical tensions, ignores about the Ebola virus outbreak, and the stock indices STI, for example, keeps on going up. So you may actually have losses from your STI index positions, but if you actually net it with the gains from your stock positions, you're actually making much lesser. So in a way, that is hedging, partial hedging. Yeah.
We can take one last question before we move on to our last speaker. Does anyone have any other questions? Right in the back.
Hi. So are options and CFDs the same thing, or do they have any differences?
For options and CFDs, I think the main difference is that for CFDs, there is no expiry date, but for options, there's actually expiry date. So for options, whenever it expires, you need to actually open a new contract the following month. But for CFDs, you can actually hold it for an indefinite period. Yeah, so basically for CFDs, there's no expiry date. So if you're going short on a particular stock, say DBS, all right, if you think that the entire DBS bank is going to collapse, you can actually hold it until the day that it really collapses, for that matter. Yeah.
Okay, thanks.
Thank you very much, ladies and gentlemen. Mr. Yi Chun Kit. You can clap, go on. These men might make you richer.
I hope so.
Our last speaker, Mr. Oommen Mathews, Chief Investment Officer, RBI Holdings, is highly sought after as a conference and seminar speaker and has something very interesting to talk to you about. I spoke to him earlier and he introduced me to the concept of aquaculture. So go ahead and tell us more about that.
Aquaculture is basically the farming of aquatic organisms, you know. The marine life in the seas is depleting by the day. And it's depleting because of two major reasons. One is overfishing, and the other one is because of oil spills happening in the sea. And that is the reason why aquaculture is very, very important today. If you want to preserve marine life, if you want to preserve seafood, if you want to preserve fishes for the coming future, aquaculture is very, very important. And that is the reason why our company went into aquaculture as well. Now, aquaculture today is, I should say, a global phenomenon which every country is adopting at the moment. Every country is going into aquaculture because they've realized the need. And every country right now doesn't want to import fishes. If I can stop importing fishes for my country and I can produce them myself, why not? It generates employment for the people in my country. I cut down on imports coming into my country. And that is the reason why many governments around the world today are very favorable towards aquaculture farming as well. So in a nutshell, it's the breeding of fishes. It's the breeding of seafood, be it ornamental fishes, be it crabs, prawns, shrimps, even sturgeon fishes, caviar, stuff like that. This is what is called aquaculture, in short, basically. So we are the first company, basically, to get into aquaculture, set up our own hatcheries here in Singapore, as well as in Sri Lanka, as well, and also offer it as an investment platform so that we can grow bigger in the coming future. And from an investor's point of view is you get your money, you make money on it, of course, you get your money back. And for us is we expand on a very, very large scale. So that's aquaculture in a nutshell, basically.
Do you want to explain what what the growing demand is, or how it affects, how is it an investment per se?
All right. The demand for aquaculture, I should say, is rising by the day. Now, for example, crabs in Singapore, or you take the case of shrimps or prawns, they are always in demand. Now, how do you gauge the demand? Very simple. You go to the market every morning, there are fishes to sell. And you'll always find customers who will come and buy the fishes over there. So the demand is always there. Now, how do we offer it as an investment platform is, our investors can invest with us either by purchasing, say, a whole pond to yourself, or buy shares in the pond. That means you co-own the pond with other shareholders as well. And whatever produce comes out of the pond is basically given to you as returns back over the next 2 years. Now, as an investment platform, yes, we do golden pomfrets, we do sea bass, we do groupers, we do red snappers, we do prawns, we do shrimps. But on an investment platform, we are offering the mud crab. That is what we're offering as an investment platform. Because the mud crabs from Sri Lanka are very, very high in demand. The Sri Lankan mud crabs, I don't know, for some reason, they are more juicier, more bigger than the crabs you can get from Thailand or from Philippines or Malaysia, stuff like that. So the mud crabs is what we offer on an investment platform. And basically, you can buy into our mud crab ponds. We have got a hatchery in Sri Lanka. You can buy into those ponds. And we retail it currently in Singapore because we cannot meet the demand of Singapore itself. The demand is so huge. And after Singapore, of course, we've got Malaysia. We also have Japan, which is a very, very huge market for seafood. Australia. China, they themselves are doing their own aquaculture production as well. So yeah, as an investment platform, we offer our mud crab investment platform as well. And the returns you're looking at, ladies and gentlemen, is not only an annual return, but it's a harvest return. One harvest is 8 months. Yeah. So the first to 8th month, you get your first return on the 9th month. Then from the 8th to the 16th month, you get your return on the 17th month. And from the 16th month to the 24th month, you get your returns on the 25th month together with your principal capital as well.
Does anyone have any questions at this point? Yes.
Yes, sir.
Okay, you say let's narrow to the mud crabs you're talking about. First, my question is, what is the return after the cost? I mean, let's say people will put $100 in. So every 8 months, are we talking about 20% after the cost? Your management fees, kind of things?
Yes, you're looking even more than 20%. On a 2-year period, you're looking somewhere around 64% returns back.
64%. Okay. But you mentioned, okay, regarding the mud crabs, do they need the special kind of mud they residue in? And do you actually own the real estate on that?
Yes, we do own the whole pond. We do hold our own real estate over there. We own the whole place as well. And mud crabs, basically, they are known as mud crabs because they grow in mangroves.
Oh, okay.
All right? And they have to be bred in a hatchery. There's a mud crab cycle ever since they're juvenile, they're crab instars to juveniles to their full-grown stage. So when they are crab instars, when they're crablets, they are bred in tanks. And then once they're juveniles, they come into nurseries. And on their grow-out stage is where we put them into ponds.
Okay. So how about, that means your cost factor also factor into insurance? Let's say there's a virus like some of the abalone, in some other company, one whole crop was wiped out, just one shot. So how would the insurance insure, or does it just ensure that you just return your principal, not the 64% you're talking about?
Correct. As I said earlier, out of all the other fishes that we harvest, we've only put mud crabs on an investment platform. And the reason we put mud crabs on an investment platform is because crabs are very, very resilient. They're resilient to every disease that marine life can face. That's basically because of what they eat. Now, if I tell you what they eat, you will stop eating crabs, trust me. They are very, very resilient. It's not like prawns. Prawns, for example, if one of them gets the white spot disease, you can have the whole pond filled with white spot disease. But that's not the case with crabs. Crabs are the carriers of the disease. But having said that, yes, there can be an epidemic that may come up in the future. And for that reason, all our ponds are insured by Willis, which is one of the biggest insurance agencies that insures aquaculture as well.
So I have a question then. What is the risk of investment in aquaculture?
Okay, there are a number of risks of investment in aquaculture. If I say there's no risk, it's not true. Number one is you are running ponds. Your water treatment that you're using, there should be 24 hours electricity and generate and stuff because the water has got to be pumped out, right? There's got to be oxygen in the water. Secondly, what if tomorrow acts of God or acts of the devil, as they call it, there's a tsunami or there is a tidal wave or typhoon or something like that? The other risk can be what if there's a widespread epidemic. Till today, crabs are not known to have any widespread epidemic, but that doesn't mean in the future they may not have. There can be new diseases that may erupt in the future. And if that happens, those are the risks basically that may wipe out your harvest. Now, when you're offering it as an investment platform, we as a company, basically, we don't need 3 harvests to pay back our investors. 1 harvest is enough to pay back our investors even for the other 2 harvests as well, right? Because when crabs are in the wild, their survival rate is only 3 to 4%. But when crabs are bred in a hatchery, their survival rate is 94, 95%. That means only 3 to 4% may not survive, right? So their survival rate is very high. So it just takes 1 harvest for us to cover up all the costs and stuff like that. And that is the risk, basically. And we as a company, when we decided to put this on an investment platform, we have employed the best technology in the world. And that is coming from SIFDEC in Philippines, sorry. SIFDEC stands for Southeast Asian Fisheries Development Center. We partner with them because they do R&Ds on a day-to-day basis, get the latest technology, the latest R&D from them. The feeds that we feed our crab is very important as well. Normally, if you look at a hatchery, they would feed the crab by just throwing the feeds into the pond, just like that. We don't do that. We make it into a fish cake kind of a thing, a rectangular fish cake, and we throw this fish cake into the pond. Now, what's the benefit of that? The benefit of that is very simple. You can monitor how much the crab has eaten. You can monitor whether it's really eating well or it's not eating well. Is it sick? So if it's sick, immediately you can take it out, nurse it, and then put it back into the pond again, which doesn't happen in the wild, which only happens in a hatchery.
Any other questions? Is there a question? Yes.
Can I ask, when you say your hatcheries, that means I'm assuming that all your hatcheries are just coastal lines, and at coastal lines, sea level, so it's subjected is God decided to make another tsunami, so the crabs is all lost. Is it that I'm driving? Is that true?
All our hatcheries are near to the sea.
Yeah.
Because the grow out happens in the sea. Now, we cannot control a tsunami, of course. If there's a tsunami or there's a tidal wave, you cannot control it. But if at all that has to happen, then we are insured by Willis, an insurance company that pays us the damages for our pond that has been destroyed, and we in turn pay our investors as well.
Just as a curious sake, I mean that shouldn't your pond be on a more elevated level, says 100 meters, highest level, so you build your pond there, You know, it's just a big, huge tank, and you pump all your seawater right inside, and you build a little ecosystem where all the mangroves are there, so that there's no risk of tsunami, or is the cost too high?
Our ponds are basically on a 5-meter height from sea level. But you can't build it too high. The cost of construction is going to jump huge because you've got to dig underground to get the seawater right into your ponds as well. Now, even if, for example, I build a 4-story height or 200 meters or 1,000 meters height, even if I have to build it, if there's a tsunami that's going to come, that's going to affect, it is going to affect at any cost. So it doesn't make sense for us to build that so high. But yes, we are on a higher level than the sea level as well in Sri Lanka.
I mean, just on curious sake, I mean, you say that the mama crabs need 8 months to grow. Is there any sort of, you know, like in some plants, they do it accelerated? Can you change the genetic code to bring in, like, say, instead of harvesting like a chicken, you know, chicken you do it in 30 days, you know, that kind of thing. Can you shrink the thing from 8 months to 1 month? Or say at least a bit more reasonable as 3 months?
No, with crab, unless I genetically inject the crab or something like that, which we don't do that. We let the crab
Steroids for
grow
crabs.
at its own pace because we want it to grow big. The bigger it grows, the better for us. We want it to grow big, we want it to grow strong, we want it to grow healthy, and not really genetic. Our feeds that we feed the crab are high protein intake, basically, so they grow bigger. But we don't genetically inject them to grow in just a month up there. No, we don't do that.
As just a curious sake, I mean, when compared to fishes, like snapper, or how long does it takes to grow them? 3 months? 6 months?
Sorry, I didn't get your question.
No, I mean, like you say you do other fishes like
Yes.
snapper. Does it take 6 months to grow snapper?
No,
that
different
kind of-
fishes are different. 8 months, what I'm talking about. Actually, crabs take 6 to 7 months. But we put it as 8 months because we are putting it on an investment platform. But no, different fishes' life cycle is different.
For example?
Now, for example, red snappers, it takes 5 months or 6 months. It grows to a sizable, you know, how big you want it to be. Now, the longer you keep it, the bigger it grows.
Oh, okay. So just learn.
I'm going to have to cut you
Okay.
off and see if somebody else has a question. Does anyone else have a question? We are running out of time, but we can take one last question from someone. No? Go ahead.
On your point of from an investor point of view, you're talking about the big cake that you lower to the crabs, right? I would assume that it's one big cake, right?
It's not so big. It's the size of a fish cake.
Or does that fish cake actually limits to one crab, or is it for all the crabs that's inside the pond?
Okay, you got to know something. Crabs are not like human beings. Human beings, if we bump into each other or bang each other, we say sorry. Crabs don't do that. Crabs are cannibals.
Or they fight for it? Is it?
Yes, the bigger fella will jump on the smaller fella. So you can't keep more than 3 crablets, I should say, sorry, in 1 square meter. If you do that, the bigger fella will try to jump on the smaller fella and kill the smaller fella. So you can have only 3. So when this fish cake we put in, right, is just enough for 3 crablets over there.
Would it be better just to cut the crab?
That was your last question, sir.
Okay.
I'm sure you have more, and I'm sure he would be more than happy to address all of your questions. Thank you very much, ladies and gentlemen. Once again, all 3 of our speakers, Mr. Kerry Wong, Mr. Yi Chun Kit, and Mr. Oommen Mathews. If you have more questions for them about CFDs and equities and aquaculture, you can approach them or their booths. Thank you very much for coming. This has been the A to Z Talk Show.